Chapter 7, Sector-Specific Effects. Introduction. This chapter delves into a comprehensive analysis of the potential impacts of the 2025 tariff implementations on specific sectors of the U.S. stock market. The effects on these sectors are dependent on the tariffs coming to effect on April 2nd. For most investors, tariffs is never something good. Those with a lot to gain from manufacturing domestic can thrive. Understanding which sectors are poised to potentially win or lose, as well as those with mixed outcomes, is crucial for investors and policymakers navigating the evolving economic landscape in early 2025. The administration's narrowed focus to apply reciprocal tariffs on a targeted set of nations, the Dirty 15, further complicates the market outlook, while introducing potential opportunities. Source: Washington.docx. Winners in the U.S. stock market. Steel industry. Companies such as Nucor and United States Steel are the most poised to gain if things stay the course with President Trump. With there being multiple economists that are concerned about long-term effects. If that is put aside, a goal can be having to gain. With steel and aluminum that have long been key. If there is new trade policies, those companies and all related might see benefits. Losers in the U.S. stock market. Agriculture industry. There has been talk and not really a goal how. Technology industry. We need things, so it can't make things like that can get to us all. If China takes a turn away, that may give them challenges. Mixed outcomes for industries. If there is new things put into place, we can make that things more so it stays for the way. It sounds like he is willing not to give that as to be said. Retail, with all that, what are all the changes? Or does anything need to come all make it easier? This that not can be made, it won't do what all said and has all to go back. But also, what does that help with everything that can come all from as well? We need something more to make sure we can keep everything straight. Sector-specific impacts analysis. Steel. Detailing how tariffs on imported steel can not only benefit domestic steel producers, agriculture. Explaining the potential to retaliate, for other countries, that those exports might come. Automobiles. To help talk how import or other auto could cause the cost, or where to come for a lot of prices or a big number where that has for what those in United States can give to the people. Retail. To make there is what is needed. It can be so the stores have more. Quantitative analysis. As it all comes, there is a point to this that makes sure we know what everything has for so. Chapter 8. Strategic adaptations to tariff policies. A quantitative and implementation-focused approach. Introduction. This chapter builds upon the economic impacts to provide actionable, quantitatively backed strategies for investors and businesses navigating the challenges and opportunities presented by the 2025 tariff policies. Recognizing the need for measurable outcomes and industry-specific solutions. This chapter outlines practical responses that include detailed metrics, risk assessments, and implementation steps. Additionally, it addresses the complexities of balancing short-term costs with long-term gains and refines the approach to measuring lobbying success. 1. Investor strategies. 1.1 Diversification across asset classes. 1. Objective: reduce portfolio volatility by allocating assets to sectors with low tariff sensitivity. 2. Action steps. Risk assessment. Measure portfolio exposure to tariff-sensitive sectors, for example, technology, consumer discretionary, using beta coefficients or correlation analysis. Allocation targets. Reduce allocation to tariff-sensitive sectors by 10 to 15%, reallocating funds to defensive sectors like utilities and healthcare. Quantifiable metric. Aim for a portfolio beta reduction of 0.1 to 0.2, indicating lower overall market risk. Industry-specific example. A portfolio heavily weighted in semiconductor stocks, for example, Nvidia, AMD, could reduce exposure by 10%, shifting funds to healthcare giants like Johnson & Johnson or United Health Group. 1.2 Hedging against volatility. 1. Objective: protect portfolio value from short-term market declines due to tariff uncertainty. 2. Action steps. Option strategy: purchase put options on affected indices, for example, S&P 500, NASDAQ, with strike prices 5 to 10% below current levels. Cost analysis: allocate 1 to 2% of portfolio value to hedge premium costs. Quantifiable metric: aim for a delta-neutral position to minimize losses during market downturns. Example: for a $1 million portfolio, allocate $10,000 to $20,000 to purchase put options with a delta close to zero. 1.3 Tactical reallocation based on sector performance. 1. Objective: capitalize on sectors benefiting from tariffs, such as domestic manufacturing. 2. Action steps: sector analysis. Monitor sector performance using indices like the Materials Select Sector SPDR Fund, XLB, or the Industrial Select Sector SPDR Fund, XLI. Investment targets: increase exposure to companies with strong domestic supply chains, for example, Nucor, United States Steel, by 5 to 10%. Quantifiable metric: aim to outperform benchmark indices by 2 to 3% annually through strategic sector rotation. Industry-specific example: an investor could increase exposure to U.S. steel producers by 5%, while reducing exposure to automakers reliant on imported steel. 2. Business strategies. 2.1 Supply chain diversification. Objective: reduce import dependence and tariff exposure by diversifying suppliers. Action steps: supplier audit. Identify key suppliers in tariffed regions and assess potential alternatives. Sourcing targets: shift 20 to 30% of sourcing to non-tariffed countries within 12 to 18 months. Quantifiable metric: measure supply chain resilience by tracking the percentage of inputs sourced from diversified regions. Implementation challenge: acknowledge that diversifying supply chains can increase costs by 5 to 10% initially. 2.2 Cost optimization strategies. Objective: offset increased costs due to tariffs through operational efficiencies. Action steps: process automation. Implement automation technologies to reduce labor costs by 10 to 15%. Contract renegotiation. Renegotiate contracts with existing suppliers to secure better pricing. Quantifiable metric: aim to reduce operating costs by 5 to 7% through efficiency improvements. Industry-specific example: a consumer electronics company could automate assembly lines to reduce reliance on imported components. 2.3 Innovation in product development. Objective: adapt products to minimize tariff impact and cater to domestic market preferences. Action steps: R&D investment. Allocate 5 to 7% of revenue to R&D for developing products using locally sourced materials. Product redesign. Redesign products to reduce reliance on tariffed components. Quantifiable metric: measure product innovation success by tracking the percentage of revenue from new or redesigned products. Industry-specific example: an automotive manufacturer could develop electric vehicles using domestically produced batteries. 3. Policy engagement. 3.1 Lobbying through industry associations. Objective: influence policymakers to secure favorable trade conditions or tariff exemptions. Action steps: collaboration. Work with industry associations to present data-driven arguments for tariff adjustments. Targeted advocacy. Advocate for specific tariff exemptions based on evidence of economic harm or job losses. Example: the National Association of Manufacturers could lobby for exemptions on critical raw materials like rare earth metals. 3.2 Measuring lobbying success. Objective: assess the effectiveness of lobbying efforts while accounting for external factors. Action steps: track policy changes. Monitor specific policy adjustments directly attributed to lobbying efforts. For example, tariff exemptions for key industries. Control for external factors. Use regression analysis to isolate the impact of lobbying from broader economic or political trends. Quantifiable metric. Measure success by the percentage of lobbying goals achieved within a defined time frame. 4. Sector-specific adaptation metrics. 4.1 Manufacturing and heavy industry metric. Increase domestic production capacity by 10 to 15% within 2 years. 4.2 Technology sector metric. Reduce reliance on tariffed components by 20% through supply chain diversification or innovation. 4.3 Consumer goods and retail metric. Maintain profit margins by adjusting pricing strategies and promoting Made in America products. 5. Addressing implementation challenges. 5.1 Balancing short-term costs with long-term gains. Objective: develop frameworks to evaluate trade-offs between immediate expenses and future benefits. Action steps: financial modeling. Use discounted cash flow (DCF) analysis to project long-term profitability under new trade conditions. Scenario planning. Create multiple scenarios, for example, best case, worst case, baseline, to assess potential outcomes of tariff strategies. Implementation barrier. Difficulty in accurately forecasting market behavior and policy changes. 5.2 Overcoming lobbying barriers. Action: engage professional lobbying firms with expertise in trade policy advocacy. Implementation barrier. Navigating bureaucratic hurdles and aligning interests across various sectors. Dependence on external factors. Success heavily relies on government policy decisions, retaliatory actions from other countries, and broader economic conditions. Conclusion. This chapter provides a comprehensive roadmap for navigating tariff policies through strategic adaptations backed by quantitative metrics, industry-specific examples, and implementation-focused actions. Investors can mitigate risks through diversification and hedging, while businesses can optimize operations and engage policymakers effectively. By acknowledging behavioral factors, implementation complexities, and dependence on external factors, stakeholders can transform tariff-induced challenges into opportunities for growth and resilience. Chapter 9. Projections for the remainder of 2025, an integrated analysis. Introduction. This chapter presents projections for the U.S. economy and stock market for the period from March 24, 2025, through December 31, 2025. These projections are based on several potential scenarios regarding tariff policy, taking into account key economic indicators and recent policy announcements. Economic scenarios. Baseline assumptions. The projections presented below incorporate current economic data as of March 2025, including GDP growth, inflation, and unemployment. Scenario 1. Sustained tariffs. Description. Under this scenario, tariffs on key imports remain at their current levels, ranging from 10% to 25%, or experience slight increases. This reflects the administration's commitment to its stated goal of equalizing trade policies, as detailed in Chapter 4. Despite concerns expressed by some economists, the administration may decide to maintain its current course. Chapter 5. Likelihood. The likelihood of this scenario depends on the administration's commitment to its stated goal of equalizing trade policies. Potential economic and market impacts. GDP growth. projected to flatline at approximately 2%. According to Congressional Budget Office estimates, a 15% tariff increase could reduce GDP by up to 0.5% annually. Chapter 5. Inflation. Inflationary pressures may increase, especially in sectors reliant on foreign inputs. Chapter 5. Unemployment. This scenario could result in continued volatility in these areas, with import-reliant sectors, for example, retail, potentially seeing increased unemployment. Chapter 5. While steel and aluminum industries could see some job gains, overall employment may be reduced due to higher prices. Stock market impact. While the overall stock market could show steady growth in these times, specific sectors will experience mixed results. Chapter 7. The steel industry, as noted in Chapter 7, could benefit, with companies like Nucor and United States Steel potentially seeing increased profitability. Scenario 2, partial rollback description. The U.S. engages in diplomatic efforts and negotiations that result in the reduction or removal of tariffs on key trading partners. Likelihood. The likelihood of this scenario depends on several factors, including the willingness of key trading partners to engage in negotiations. Potential economic and market impacts. GDP growth. A modest recovery to approximately 2.5% could be anticipated, driven by improved business sentiment and increased trade activity. Chapter 5. Inflation. Gradual reduction in tariffs could ease price pressures, benefiting consumers and import-reliant industries. Chapter 5. Sectoral improvements. Industries like agriculture and technology could see improvements as retaliatory tariffs are lifted, potentially leading to increased exports. Scenario 3, tariff escalation description. Under this scenario, the U.S. imposes new tariffs or increases existing ones, leading to greater trade tensions. Potential economic and market impacts. GDP growth. GDP could decline below 1%. As noted in Chapter 5, the Congressional Budget Office estimates that a 15% tariff increase could decrease U.S. GDP by 0.5%. Inflation. Inflationary pressures would be amplified across multiple sectors. Chapter 5. Unemployment. Widespread layoffs are expected in industries reliant on imports or exports. Chapter 5. Stock market impact. The market could react negatively, with increased volatility and declines in key sectors. Chapter 6. Sectoral forecasts. The effects on these sectors are dependent on the tariffs coming to effect on April 2. Chapter 7. For most investors, tariffs are never something good. Those with a lot to gain from manufacturing domestic can thrive. Understanding which sectors are poised to potentially win or lose, as well as those with mixed outcomes, is crucial for investors and policymakers navigating the evolving economic landscape in early 2025. Steel industry companies such as Nucor and United States Steel are the most poised to gain if tariffs stay at their current course. With increased domestic demand. Chapter 7. This offsets concerns about long-term economic effects. As mentioned in Chapter 5. Agriculture industry. Retaliatory tariffs from trading partners could significantly hurt U.S. agricultural exports. Chapter 7. Technology industry. Continued volatility due to supply chain disruptions from tariffs on semiconductors and electronics. Chapter 7. However, domestic tech companies may benefit from government support and incentives for reshoring. Automobiles and retail. These sectors are expected to experience mixed outcomes, with increased costs for imported components potentially offset by increased domestic production. Chapter 7. Monthly breakdown. June. Early signs of stabilization or further correction in economic indicators. Chapter 6. September. Potential Federal Reserve policy adjustments in response to mid-year economic data, as well as potential domestic policy shifts. Chapter 8. December. Year-end market performance reflecting the cumulative impact of tariff policies. And other economic factors. Chapter 6. Key variables: Federal Reserve rate adjustments. Potential rate cuts to 4% by Q4 to stimulate growth. Amid trade-related slowdowns. Chapter 8. Domestic political developments. Influencing market sentiment and policy decisions. Chapter 8. U.S. business investment trends. Shifting supply chains and investment patterns in response to tariff policies. Stakeholder impacts: These tariff scenarios have significant implications for U.S. consumers, who may face higher prices for both domestically produced and imported goods. There will be challenges for businesses reliant on imports or domestic supply chains, as detailed in Chapter 11. Historical context: The current situation shares some similarities with past U.S. tariff policies, like the Smoot-Hawley Tariff Act, as discussed in Chapter 10, but also key differences in the global economic landscape. Chapter 10, Historical Context, Specific Parallels. Introduction: This chapter delves into the historical context of U.S. tariff policies, with a particular focus on the Smoot-Hawley Tariff Act of 1930, to draw parallels and lessons for the 2025 tariff policies. By examining the economic and political conditions that led to the Smoot-Hawley Tariff Act, its intended goals, and its actual outcomes, we can better understand the potential risks and benefits of the 2025 tariff implementations. This analysis will also highlight the differences between the 1930s and the present day, offering insights into how modern economic tools and global trade dynamics might mitigate or exacerbate the effects of tariffs. The Smoot-Hawley Tariff Act of 1930. A detailed analysis. Background and context: The Smoot-Hawley Tariff Act was enacted in June 1930, during the early stages of the Great Depression. It raised tariffs on over 20,000 imported goods, with the aim of protecting American industries and jobs from foreign competition. The act was a response to the economic turmoil of the time, characterized by high unemployment, falling agricultural prices, and a struggling industrial sector. Protectionist sentiment was strong, as many policymakers believed that tariffs could shield domestic industries from cheaper foreign imports. Economic conditions: The U.S. economy in 1930 was in dire straits. Unemployment was rising, and many industries were struggling to compete with cheaper foreign imports. The agricultural sector, in particular, was hit hard by falling prices, leading to widespread rural poverty. In this context, protectionist policies like the Smoot-Hawley Tariff Act gained traction as a means of shielding domestic industries from foreign competition. Stated goals versus actual outcomes: The Smoot-Hawley Tariff Act was intended to protect American industries and reduce unemployment. However, the actual outcomes were far from the intended goals. Reduced international trade. The tariffs led to a sharp decline in international trade. U.S. exports fell by approximately 61% from 1929 to 1933, and imports dropped by 66%. During the same period, Irwin, 2011. This decline in trade exacerbated the economic downturn, as global markets contracted, exacerbated the Great Depression. Most economists agree that the Smoot-Hawley Tariff Act worsened the Great Depression. By reducing global trade, the tariffs deepened the economic crisis both in the U.S. and abroad. Friedman and Schwartz, 1963. The act contributed to a downward spiral of global trade, as other countries retaliated with their own tariffs. Industry-specific impacts. While some domestic industries initially benefited from reduced foreign competition, many others suffered due to higher input costs and reduced export opportunities. Crusini and Irwin, 2011. For example, manufacturers that relied on imported raw materials faced increased production costs, which hurt their competitiveness. Global political climate. The global political climate in the 1930s was marked by rising nationalism and protectionism. The Smoot-Hawley Tariff Act contributed to increased international tensions, as other countries retaliated with their own tariffs. This tit-for-tat escalation hindered efforts to address the global economic crisis through international cooperation, further deepening the economic downturn. Specific industries affected: agriculture. American farmers, already struggling with low prices, saw their export markets shrink due to retaliatory tariffs. Schnepf, 2005. The loss of export markets exacerbated the economic challenges faced by the agricultural sector. Manufacturing. While some manufacturers benefited from reduced competition, many others faced higher costs for imported raw materials and components. This increase in production costs hurt their competitiveness in both domestic and international markets. Consumer response. American consumers faced higher prices for imported goods, reducing their purchasing power and contributing to the overall economic downturn. The increased cost of living further strained households already struggling with the effects of the Great Depression. Long-term legacy. The Smoot-Hawley Tariff Act is widely regarded as a policy failure that exacerbated the Great Depression and contributed to global economic instability. It serves as a cautionary tale about the dangers of protectionism and the importance of international trade cooperation. Similarities and differences with the 2025 tariff policies. Similarities: domestic industry protection. Like the Smoot-Hawley Tariff Act, the 2025 tariff policies aim to protect domestic industries from foreign competition. Chapter 4. Both policies are rooted in the belief that tariffs can shield domestic industries from global competition. Reciprocal tariffs. The 2025 policies mirror the reciprocal tariffs in April 2, Chapter 4. Just as the Smoot-Hawley Tariff Act led to retaliatory tariffs from other countries, the 2025 policies could provoke similar responses from trading partners. Consumer impact. In both cases, consumers are likely to face higher prices for imported goods, reducing their purchasing power. As stated in Chapter 5, a 2019 paper written by economists at the Federal Reserve and Columbia and Princeton universities estimated that the 2018 tariffs led to declines in real income and increases in prices for U.S. consumers, with the cost borne almost entirely by domestic consumers. Differences. Global economic landscape. The global economy in 2025 is far more interconnected and interdependent than it was in 1930. The role of international organizations like the World Trade Organization, WTO, and the complexity of global supply chains may limit the impact of tariff policies. Irwin, 2017. In contrast, the 1930s global economy was less integrated, and the lack of international trade frameworks like the WTO made it easier for countries to engage in protectionist policies. Monetary policy. In 2025, central banks like the Federal Reserve can use monetary policy tools to mitigate the negative impacts of tariffs, while in 1930, such tools were limited. Eichengreen, 2008. 2. Modern central banks have more sophisticated tools, such as interest rate adjustments and quantitative easing, to manage economic shocks. 3. Policy response. In 2025, there is greater awareness among policymakers of the potential negative consequences of protectionism, which may lead to more cautious and targeted tariff policies. 3. In contrast, the Smoot-Hawley Tariff Act was enacted during a time when the economic understanding of tariffs and their impacts was less developed. Lessons learned and policy recommendations. Connected to 2025 policies. Avoid broad protectionism. Recommendation. The Smoot-Hawley Tariff Act demonstrates the dangers of broad protectionist measures. Targeted tariffs, based on specific economic analyses, may be more effective. In the 2025 context, as discussed in Chapter 7, it might be more appropriate to focus on specific industries, such as steel, where domestic producers could benefit, rather than implementing broad tariffs that could harm various sectors. The administration's narrowed focus to apply reciprocal tariffs on a targeted set of nations, the Dirty 15, further complicates the market outlook. while introducing potential opportunities. Source: Washington.docx. Consider retaliatory effects. Recommendation: policymakers must carefully consider the potential for retaliatory tariffs from other countries, which can offset any benefits of domestic industry protection. As mentioned in Chapter 5, Trump says reciprocal tariffs will kick in on April 2nd, when the U.S. will match the higher tariffs other countries impose on the U.S. Foster international cooperation. Recommendation: international cooperation and trade negotiations are essential for addressing global economic challenges and avoiding trade wars. The economic team mentioned there are trade imbalances between countries and a few negotiations with other nations to help those plans, as shown in Chapter 5. Support affected industries. Recommendation: government support and assistance may be necessary to help industries and workers adjust to the impacts of tariff policies. As for the automobile industry, the new things that put into place help those for the way. Chapter 11, Stakeholder Impacts, a deep dive. Introduction. 1.1. Purpose. This chapter provides a rigorous analysis of the diverse and interconnected impacts of the 2025 tariff policies on key stakeholders within the U.S. economy: consumers, businesses, and workers. Moving beyond descriptive accounts, it explores why and how these impacts manifest, assessing their relative significance and evolution over time. 1.2. Context. The 2025 tariff landscape is characterized by the potential revival of Trump-era measures, Chapter 4, including sector-specific tariffs on automobiles, pharmaceuticals, and semiconductors, slated to take effect on April 2nd. The implementation of reciprocal tariffs has the potential to disrupt trade, creating both winners and losers across the economy. 2. Impact on U.S. consumers. A multidimensional analysis. 2.1. Price changes. Why and how? Tariffs act as a tax on imports, directly increasing the cost of goods entering the U.S. market. Businesses often pass a portion, or all, of these costs on to consumers in the form of higher prices, leading to inflationary pressures. The magnitude of these price increases depends on several factors. 1. Overall inflation. Tariffs imposed in 2025 are likely to exert upward pressure on overall inflation in the U.S., Chapter 5. 2. Specific goods. Clothing and apparel. Tariffs on imported textiles and apparel are projected to cause price increases ranging from 5% to 15%, source: industry report. Electronics, smartphones, laptops, appliances. Due to complex global supply chains, tariffs on imported electronics components could drive up prices by 10% to 30%, particularly for goods sourced from China, source: Tech Industry Analysis. Automobiles, imported versus domestically produced. Tariffs on imported automobiles are projected to add 1,000 to 1,000 to 5,000 to vehicle prices, affecting both imported and domestically produced cars. Due to integrated supply chains, source: Auto Industry Report. Food and agricultural products, due to retaliatory tariffs. Retaliatory tariffs on U.S. agricultural exports could lead to price hikes for certain food products, for example, soybeans, pork, for American consumers, source: USDA data. 3. Data sources. Bureau of Labor Statistics, BLS, Bureau of Economic Analysis, BEA. U.S. Department of Agriculture, USDA, industry-specific reports, and academic studies. Effects on household purchasing power. Why and how? Higher prices erode household purchasing power, reducing the quantity and quality of goods and services that consumers can afford. This effect is amplified for low-income households, who spend a larger proportion of their income on necessities. 1. Income distribution. Lower-income households will be disproportionately affected by price increases due to tariffs, exacerbating existing income inequality. Major impact. 2. Consumer behavior. Consumers are likely to reduce discretionary spending, for example, dining out, entertainment. Postpone major purchases, for example, appliances, cars, and increase reliance on credit to cope with higher prices. Moderate impact. 3. Consumer confidence. Tariff-related uncertainty is likely to dampen consumer confidence, leading to a decline in overall spending and slower economic growth. Moderate impact. Impact on U.S. businesses, winners, losers, and adaptation strategies. Segmented analysis. Why and how? The impact of tariffs on U.S. businesses varies significantly depending on their size, sector, import reliance, and export orientation. 1. Large corporations. Winners. Domestic steel and aluminum producers, as identified in Chapter 7, stand to gain from reduced foreign competition and increased domestic demand. Major impact, short term. Companies such as Nucor and United States Steel are poised to benefit. Losers, import-reliant manufacturers, retailers, and tech companies will face challenges related to supply chain disruptions and increased costs. Major impact. Adaptation strategies. Businesses may consider reshoring production, diversifying supply chains, automating production processes, seeking tariff exemptions, or absorbing some of the cost increases. Varying impact. 2. Small and medium-sized enterprises, SMEs, disproportionate impacts. SMEs are generally more vulnerable to tariff-related challenges due to limited resources, lower negotiating power, and greater dependence on specific suppliers or markets. Major impact. Specific challenges. SMEs may face difficulties in accessing capital to finance supply chain adjustments, absorbing cost increases, and competing with larger firms. Government assistance. The Small Business Administration, SBA, offers resources and programs to support SMEs, but the effectiveness of these measures may be limited. Moderate impact. 1. Steel. Tariffs on imported steel can benefit domestic steel producers by increasing demand for their products and allowing them to raise prices. Short-term gain. 2. Agriculture. Retaliatory tariffs from trading partners could significantly harm U.S. agricultural exports, leading to reduced income for farmers and potential disruptions in agricultural supply chains. Major impact, medium term. 3. Automobiles. Tariffs on imported auto parts could increase costs for both domestic and foreign automakers, affecting vehicle prices and consumer demand. Moderate impact. 4. Technology. Tariffs on semiconductors and electronics could disrupt supply chains and increase production costs for tech companies. Major impact. Impact on U.S. workers. Job creation, job losses, and wage effects. Employment shifts. Why and how? Tariffs can lead to shifts in employment patterns as certain industries expand while others contract. However, the net effect on overall employment is uncertain and depends on a variety of factors. 1. Job gains. The steel and aluminum industries could see some job gains as a result of tariffs, although these gains may be modest compared to the overall size of the U.S. labor market. Minor impact, short term. 2. Job losses. Sectors reliant on imported inputs or exports, for example, retail, agriculture, could experience job losses due to higher costs and reduced competitiveness. Moderate impact, medium term. 3. Geographic distribution. Job shifts may disproportionately affect regions heavily reliant on manufacturing, agriculture, or trade-related activities, exacerbating regional economic disparities. Moderate impact, long term. Wage effects. Why and how? Tariffs can impact wage growth through several channels. 1. Wage stagnation. Tariffs could suppress wage growth, particularly in sectors facing increased costs and reduced competitiveness, as businesses seek to control expenses. Moderate impact. 2. Real wage decline. Inflation erodes the purchasing power of wages, reducing the living standards of American workers, especially those in low-wage jobs. Moderate impact. Worker training and adjustment programs. 1. Availability. Government programs, such as the Trade Adjustment Assistance (TAA) program, provide retraining and support to workers displaced by trade-related job losses. 2. Effectiveness. The effectiveness of these programs in helping workers find new employment may vary depending on local economic conditions and the skills required for available jobs. Limited impact. Mitigating factors and policy responses. Government subsidies and assistance. Why and how? Government subsidies and assistance programs can provide temporary relief to stakeholders affected by tariffs, but they may also distort market signals and create unintended consequences. 1. Agricultural subsidies. Government subsidies may provide temporary relief to farmers affected by retaliatory tariffs, moderate impact, short term. 2. Manufacturing incentives. Tax breaks and other incentives could encourage domestic manufacturing, but their effectiveness in offsetting the negative impacts of tariffs may be limited impact, long term. Monetary policy responses. 1. Federal Reserve actions. The Federal Reserve may adjust interest rates or implement other monetary policies to mitigate the economic impact of tariffs, but these measures may have limited effectiveness in addressing structural problems, limited impact. Trade negotiations and agreements. 1. Potential for trade deals. New trade agreements could reduce or eliminate tariffs, easing the burden on consumers and businesses, positive impact, long term. 2. Impact on stakeholders. The economic team has been in negotiations with other nations to help those trade plans with other countries, and a focus on ensuring that global trade markets won't fall, positive impact, varying with specifics. Conclusion. A nuanced assessment of stakeholder impacts and policy implications. Summary of key findings. The 2025 tariff policies are expected to generate mixed and often unequal impacts across different stakeholder groups in the U.S. economy. While some domestic industries may benefit from reduced foreign competition, consumers, import-reliant businesses, and workers in export-oriented sectors are likely to face significant challenges. Overall assessment. The net effect of the tariffs on the U.S. economy and society is likely to be negative, as the costs to consumers, businesses, and workers outweigh the benefits to a few protected industries. Moreover, the potential for retaliatory actions from other countries and the distortion of global supply chains could exacerbate these negative impacts in the long run. In light of these findings, policymakers should carefully consider the potential consequences of tariff policies and explore alternative approaches to promoting economic growth and competitiveness. These alternatives may include investing in education and training to enhance the skills of the U.S. workforce, promoting innovation and technological advancements to boost productivity, negotiating trade agreements that reduce barriers to trade and promote fair competition. Chapter 12, Conclusion and Investor Guidance. Actionable strategies for the tariff landscape of 2025. Navigating the tariff landscape of 2025. A proactive approach for investors. The year 2025 presents a unique set of economic conditions, shaped by the resurgence of tariff policies. As detailed throughout this book, these policies carry both potential risks and opportunities for investors. We've explored the historical context, delved into the economic impacts across various sectors, and examined the implications for key stakeholders. This final chapter serves as a guide, offering actionable strategies to help investors navigate this complex landscape, mitigate potential risks, and capitalize on emerging opportunities. As one official close to Trump noted, this move can be affected by political shifts as well, and his decision to impose tariffs could change. Investor strategies for risk mitigation. Protecting your portfolio. One of the primary concerns in a tariff-driven environment is the potential for negative impacts on specific industries. Reducing exposure to sectors identified as losers in Chapter 7, such as agriculture and technology, is crucial. This can be achieved through diversification, strategically allocating investments to sectors less sensitive to trade policies. Consider sectors with stable demand and pricing power, such as healthcare, utilities, and consumer staples. Within the healthcare sector, focus on specific subsectors that demonstrate resilience to tariff-related disruptions. Pharmaceuticals, companies with strong pipelines of patented drugs, such as Johnson & Johnson, J&J, or Pfizer, PFE, may be more resilient due to inelastic demand. Consider also companies focused on biosimilars, such as Amgen, AMGN, as they may benefit from cost-conscious healthcare providers seeking lower-priced alternatives. Medical devices. Look for companies that produce essential medical equipment with diversified product portfolios and limited reliance on imported components, such as Medtronic, MDT, or Stryker, SYK. Companies focused on innovative surgical robotics, such as Intuitive Surgical, ISRG, may also demonstrate resilience. Healthcare IT, digital health solutions and telemedicine providers, like Teladoc Health, TDOC, or Cerner, CERN, may benefit from increased demand for cost-effective healthcare delivery. Companies focused on data analytics and artificial intelligence in healthcare, such as United Health Group, UNH, may also offer growth potential. Diversification means not putting all your eggs in one basket, spreading your risk and potential reward across different areas. For a conservative investor, allocating 15 to 20% of your portfolio to these sectors could provide a buffer against tariff-related volatility. Market volatility is another significant risk factor. To safeguard your investments against potential downturns, consider employing hedging strategies. Purchasing put options on broad market indices like the S&P 500, SPY, or on sector-specific ETFs like the Healthcare Select Sector SPDR Fund, 45, can provide downside protection. Alternatively, inverse ETFs, which increase in value when the market declines, can serve as a hedge against market fluctuations. The ProShares Short S&P 500, SH, is an example of an inverse ETF. For a risk-averse investor, allocating 5 to 10% of your portfolio to hedging strategies may be prudent. Consulting with a financial advisor to determine the appropriate hedging strategy, based on your individual risk tolerance and investment goals, is highly recommended. Furthermore, tariffs can significantly impact currency exchange rates, which in turn affects the value of international investments. Currency risk management is therefore essential. Consider hedging currency risk by using currency forwards or options to lock in exchange rates for future transactions. A foreign exchange specialist can help you develop a currency hedging strategy tailored to your specific portfolio and international exposure. Sector-specific investment recommendations. Identifying opportunities. While some sectors face headwinds, others may benefit from the tariff landscape. Domestic steel and aluminum producers, identified in Chapter 7 as potential winners, could see increased demand and profitability. However, it's important to note that the extent of increased profitability will depend on factors such as the specific types of steel and aluminum products, the level of domestic demand, and the ability of these producers to compete with imports even with tariffs in place. Companies like Nucor, NUE, and United States Steel, X, could see short-term gains, but long-term sustainability depends on their ability to innovate and compete globally. Likewise, sectors poised to benefit from reshoring initiatives, as companies seek to bring manufacturing back to the United States, may present investment opportunities. Seek out companies with strong domestic supply chains, as they are less vulnerable to disruptions caused by tariffs on imported goods. It's important to understand that the domestic businesses that they invest in aren't likely going to be willing to take any hits from that additional costs either, so they will pass them on to consumers. However, it's equally important to exercise caution in sectors facing uncertainty, such as automobiles, semiconductors, and agriculture. The automobile industry faces potential disruptions due to tariffs on imported parts, while the semiconductor industry may experience supply chain challenges. Agriculture is vulnerable to retaliatory tariffs from other countries, potentially impacting export markets. Alternative investment strategies. Exploring beyond traditional stocks in addition to traditional stock market investments. Consider alternative investment strategies that may be relevant in a tariff-driven environment. Real estate. Tariffs can impact construction costs and housing affordability. Commercial real estate, particularly logistics and warehousing, for example, Prologis, PLD, Duke Realty, DRE, may benefit from increased demand for domestic distribution centers. Data centers, for example, Equinix, EQIX, Digital Realty Trust, DLR, and healthcare facilities, for example, Welltower, WELL, Ventas, VTR, may also be relatively resilient due to their essential nature and long-term lease agreements. Expect potential returns in the range of 6 to 10% annually, depending on the specific right and market conditions. Be mindful that higher construction costs could negatively impact new development projects. Commodities. Precious metals like gold and silver can serve as a hedge against economic uncertainty and inflation. In a tariff-driven environment, increased economic uncertainty and inflationary pressures can drive up demand for these safe haven assets. Consider allocating a small portion, 3 to 5%, of your portfolio to gold through ETFs like the SPDR Gold Trust, GLD. Energy commodities like oil and natural gas may also be affected by tariffs, depending on their impact on global trade and economic growth. 2. Investors can navigate these markets through ETFs like the United States Oil Fund, USO, or the United States Natural Gas Fund, UNG. But be aware of the volatility and risks associated with these investments. 2. Industrial metals, such as copper and aluminum, may experience price fluctuations due to tariffs on imported raw materials. 3. Private equity. Private equity firms may invest in companies adapting to the changing trade landscape, offering potential for higher returns but with increased risk. 3. Look for firms with expertise in sectors poised to benefit from reshoring or supply chain diversification. 3. However, private equity investments are illiquid and require a long-term investment horizon. 3. Potential returns in private equity can range from 10 to 20% annually. But these investments are also subject to higher fees and greater uncertainty. International investment considerations. Navigating global trade dynamics. Given that tariffs are inherently international trade policies, it's crucial to consider the implications for international investing. 1. Currency impact. Tariffs can impact foreign currencies, affecting the value of investments in those countries. 1. A stronger US dollar can make investments in foreign currencies less attractive, while a weaker dollar can boost returns. 2. Hedging strategies. To hedge international investment risk in a tariff environment, consider using currency forwards or options to lock in exchange rates. 2. Currency hedged ETFs, such as the iShares Currency Hedged MSCI ETF, HEFA, or the Wisdom Tree Europe Hedged Equity Fund, HEDJ, can also provide protection against currency fluctuations. 3. Emerging versus developed markets. Emerging markets may be more vulnerable to trade disruptions caused by tariffs, while developed markets with diversified economies may offer greater stability. 3. However, emerging markets may also offer higher growth potential if they can successfully navigate the tariff landscape. 3. Investors seeking exposure to emerging markets could consider ETFs like the iShares MSCI Emerging Markets ETF, EEM, but should be prepared for increased volatility. Active versus passive investing. Adapting your strategy. Tariff policies can influence the choice between active and passive investment strategies. Active management. In a tariff-driven market, characterized by increased volatility and sector-specific disruptions, active management may be more suitable. Active managers can use their expertise to identify companies that are well positioned to navigate the changing trade landscape and capitalize on emerging opportunities. Look for actively managed funds with a strong track record of outperforming their benchmarks in volatile markets. Passive investing. Passive investment strategies, such as index funds, offer diversification and lower costs but may not be as responsive to changing market conditions. However, they can still provide a solid foundation for a long-term investment portfolio. Consider low-cost index funds, like the Vanguard Total Stock Market ETF, VTI, or the iShares Core S&P 500 ETF, IVV. ESG, environmental, social, and governance factors. Integrating sustainability considerations in today's investment landscape. ESG factors are increasingly important. Tariffs can affect ESG considerations in several ways. Supply chain sustainability. Tariffs can disrupt supply chains, potentially leading to increased reliance on suppliers with lower ESG standards. Labor practices. Tariffs can create pressure to reduce labor costs, potentially leading to exploitation of workers. Environmental compliance. Tariffs can impact companies' ability to invest in environmental compliance and sustainable practices. Investors should consider these ESG factors when making investment decisions in a tariff-driven environment. Look for companies that prioritize sustainability, ethical labor practices, and responsible environmental stewardship. ESG-focused ETFs, such as the iShares ESG-aware MSCI USA ETF, ESGU, or the Vanguard ESG US Stock ETF, ESGV, can provide exposure to companies with strong ESG profiles. Behavioral finance. Avoiding emotional decision-making in a tariff-driven market. It's crucial to be aware of the role of investor psychology and behavioral biases. News headlines about trade wars and economic uncertainty can trigger emotional responses, leading to impulsive buying or selling decisions. Common biases to be aware of include loss aversion, the tendency to feel the pain of a loss more strongly than the pleasure of an equivalent gain. This can lead investors to sell winning stocks too early and hold on to losing stocks for too long. Confirmation bias, the tendency to seek out information that confirms existing beliefs and ignore information that contradicts them. This can lead investors to overestimate the positive impacts of tariffs on certain sectors and underestimate the negative impacts on others. Herd mentality, the tendency to follow the crowd, even if it goes against your own best judgment. This can lead to speculative bubbles and market crashes. To avoid these pitfalls, stick to a disciplined investment strategy based on your long-term goals and risk tolerance. Avoid making decisions based on fear or greed. Focus on fundamentals and conduct thorough research before making any investment decisions. Consider setting up a systematic investment plan, SIP, to automate your investment decisions and reduce the temptation to time the market. Seek advice from a financial advisor to help you stay objective and avoid emotional decision-making.